Okay, welcome everybody. So today we have our day 5 of our annual online conference from the Association for Heterodox Economics. So today we have our session number 4, which is on history of economics. So we have our 3 presenters here today. So first we have Nicolás Águila, who's from the Interdisciplinary Center for the Study of Public Policies in Argentina. And his presentation is entitled Assessing the Debate on the Commodity Character of Marx's Theory of Money and its Contemporary Validity. Then we have Karen Helveg Petersen, who is an independent researcher. And the title of her presentation is The Money View and Marx's Theory of Money and Credit. And then our third presenter today is Juan Santarcángelo, who's from the National University of Quilmes and CONICET in Argentina. And his presentation is on Marxian theories and economic development, roots, boom, setbacks, and contributions to development. So I'm the chair of the session. My name is Danielle Guizzo. And for those who are attending today, a warm welcome. So if you'd like to share this session on social media, our hashtag is AHE2020 on Twitter. And we're going to have all 3 sessions, and attendees are more than welcome to drop questions. So you just go to the bar below and drop your question on the Q&A box. And if you're also having any technical issues, I have my AHE colleague here with me, Eurodollar, and you can just drop her a message on the chat box if you're having any technical difficulties, okay? So I'll give the floor to our first presenter, who is Nicolás. So Nicolás, can you please share your screen? Thank you. So there is a question about the session being recorded. Yes, this is being recorded, and we're going to share this on the website afterwards. So Nicolás, you have 20 minutes, and I'll let you know when you have 5 minutes to the end.
Okay, thank you. Thanks everyone for being here, and thank you Danielle and Ingrid for organizing this amazing event. My paper today will be on the debate on the commodity character of Marx's theory of money, which is a debate that really started with the fall of the Bretton Woods system in the mid-70s, but took off during the 90s and early 2000s, and then it progressively stopped being a big problem, I would say. Basically, the debate contested 3 different positions. The first one argued that Marx had a commodity theory of money, and therefore his theory of money has not stood the test of time properly, and it can no longer explain the functioning of a system in which gold does not actually circulate. The second position argues that in Marx's theory, money is determined by its social functions, so it's not to be a commodity. And according to this position, gold was a historical contingency, but not a theoretical nor a practical necessity in Marx's view. And finally, the third position argues that while Marx argued that money must be a commodity and gold by historical reasons, he also explained how it could be replaced by symbols of value in some functions, and how it was only ideally needed in the performance of others. So for them, the fact that gold doesn't circulate anymore does not pose a problem at a high level of abstraction. It's only a problem when it comes to understanding contemporary monetary forms. My own take on this debate is that it truly overlaps 2 different debates. The first one is about the internal consistency of Marx's theory of money, and in particular, whether or not his theory, his commodity theory of money can accommodate or not non-commodities performing functions of money. If Marx claimed that only gold could function of money, then there is a huge problem at a high level of abstraction. But if he didn't, then the fact that gold doesn't circulate anymore is not so much a problem for the theory itself. The second debate is how to understand current monetary forms. I think that regardless of the position taken on the first debate, this question is still open, and there have been different attempts within Marxist theory to explain particularly banknotes issued by central banks. For example, some argue that they are representatives or tokens for precious metals. Others argue that they are credit monies. Others argue that they are an alloy form of money between credit money and legal tender. And finally, some argue that they are a fictitious capital, the liability of the state. So today I will only discuss the first of these two debates. The second one will be a matter of a further contribution. But I think this is the right path because the first debate is ontologically and analytically prior to the second one. And sometimes when these two levels of analysis get mixed, there are some problems. So in order to analyze the internal consistency of Marxist theory of money, I will go through quickly what Marx understood as money in Capital Volume 1. So basically, Marx starts with what money is instead of by what money does. This is something that opposes his theory compared to neoclassical economics, or even some Marxist scholars who start directly by the functions of money, losing sight of what money ontologically is. Marx, first of all, argues that in capitalism, producers are autonomous and independent, so they have to go to the market in order to validate their work and in order to get the use values produced by others that they need to reproduce themselves. So in his view, exchange is a key moment in social reproduction. And if commodities can be traded in the market, it's because they have something in common that makes them quantitatively and qualitatively commensurable, and that is value, socially necessary abstract labor time, produced autonomously independently. However, you can grab a commodity and twist and turn it, and you will not be able to grasp it as a thing possessing value, because value is a social relationship, and as such can only be expressed in the relationship between two commodities. So value, commodities cannot in themselves express their own value, but have to express their own value in the body of another commodity. And this is what Marx calls exchange value, or the value form, the way in which value, the necessary way in which value has to express itself. So to analyze this, Marx starts with the simple form of value, which is just the relationship between any two commodities. And he says that in this relationship, the two commodities play two different functions. One is the relative commodity and the other is the equivalent. And for our purposes, the important dimension is that in the equivalent, use value becomes the form of appearance of value, that the concrete labor that produced the equivalent becomes the form of a manifestation of abstract labor. And finally, that the private labor that produced the general equivalent takes the form of social labor. So then Marx goes to the total or expanded form of value, finally then to the general form of value, and finally he arrives at money, which is when one commodity, through the historical process and the social custom, becomes the general equivalent. And in Marx's view, that was gold. So gold, the choice of gold was a contingency in his analysis, but not the fact that money must be a commodity. It could be any commodity, but it has to be a commodity. So if money were not itself a commodity, it could not act as an equivalent in Marx's view. And I think this is pretty clear, and I have just two quotes to show this. He says that gold confronts the other commodities as money only because it previously confronted them as a commodity. And then he says confusion between these two attributes, meaning value and value form, has misled some writers into maintaining that the value of gold and silver is imaginary. In fact, the fact is that money can, in certain functions, be replaced by mere symbols of itself, gave rise to another mistaken notion that it is itself a mere symbol. So what he's trying to say here is that no relative commodity could express its value in the body of a valueless object, in the same way as no heavy object will express its weight in the body of a weightless object. So the money must have value, and money must be a commodity. Whether gold or not is a different issue. Of course, this is a point of contention by different Marxist theories, in particular the ones that I framed under the second position at the beginning. For example, Mosley argues that money is a social convention. Reuten and Williams argue that money is a pure form in their form theoretic approach. Some Marxist scholars following chartalist or neo-chartalist perspective argue that money is determined by the state. And finally, there are many authors who argue that money is credit. For example, the Italian circuitist approach and the circuit of capital approach. I discussed all these positions in more depth in the article, which is in the webpage. But for our purposes, the only thing that I will say is that I think that regardless of whether they are right or wrong, they do not reflect accurately, in my view, what was Marx's own position. I think he was very clear that money must be a commodity. So once he found what money is, he goes on to show what money does. And he starts with the measure of values. He shows that money is the necessary form of appearance of the immanent value of commodities, allowing the expression of the values in magnitudes of the same denomination. And then a standard of price comes upon this measure of value function in order to put the same standard measure into that. So according to Marx, the price of commodities is an ideal or notional form, because in order to say that X commodity is worth Y pounds, you do not need to have the Y pounds there. You only have to say this commodity is worth Y pounds. So you don't need the physical presence of gold for that function. You only need purely imaginary or ideal gold. And then Marx says that since the standard of money is conventional and it must possess universal validity, is in the end regulated by law. But here we can see that the state comes after. First, Marx discusses the ontology of money, and then the function of the measure of values, and then the standard of price. And the role of the state is limited to regulating the standard of price, but plays no role on the ontology of money or in the function of measure of values. The second function of money is the means of circulation. Money here acts as an agent in the metamorphosis of commodities, allowing commodities to be traded. And here money must be physically present, because when you trade a commodity, you need to give the commodity and get money in exchange, and the other way around. So you need the physical and actual presence of money there. However, from this function, Marx develops the existence of symbols of value. He says that there are two reasons for this. The first one is theoretical, since in CMC, money is just a transient moment, because you are selling in order to buy. The material is not important, because you will get the money and quickly buy something else. So it's a transient moment. And second, where the practical reason is that when coins circulated, they had a nominal value and then a metallic content, which didn't necessarily reflect the nominal value, because in the process of circulation, coins were down. So even when you have actual gold coins circulating, then they are symbols anyway. So with regard to this function, Marx says that money must be a commodity, but gold can be replaced as a means of circulation for symbols of value. The symbol emerges spontaneously out of commodity money in circulation. But the important point for me is that in order to understand the symbol, you need to understand what is symbolizing. If you go straight to the symbol of something and you don't understand that something, then you are losing sight of the content of that particular form. And I think that some authors who go straight to saying that money is a mere symbol miss sight of what the symbol is actually symbolizing. Here again, Marx introduces the state externally in order to show that the symbol must have an objective social validity, but then again, the state comes only after Marx discussed the ontology of money and the function of means of circulation, and even the existence of symbols. So the state plays a limited role in the theory of money. The third function is what Marx calls money as money, which is in turn divided in three sub-functions. The first one is hoarding. Since gold is directly exchangeable, it becomes the expression of wealth in general. People can, having gold, people can buy directly commodities, and it starts to act as a measure of the wealth of the owner of gold. Marx was somewhat ambiguous about this, but there are some authors who argue that only commodity money can function as hoard because fiat money or the symbol does not possess value in its own body. However, people do not actually keep the gold. They go and deposit it in a bank, for example, and what they get in exchange is a certificate of their property upon that gold. So, and that certificate can then circulate and everything that we all know. But what is relevant is that even though the hoarder of gold needs gold, what it really gets is a certificate symbolizing his property over that gold. So gold does not truly have to be physically present anymore. The second function of money as money is the means of payment. Now the alienation of commodities becomes separated from their realization. Commodities can change hands before being sold. The seller becomes a creditor and the buyer a debtor. And one important point here is that the balancing of payments allows a reduction in the amount of money in circulation required, or more precisely, money here only acts as an accounting operation, because when we clear balances, we do not need to actually exchange the money, we just settle for the difference. So first, it reduces the amount of money required. However, in crisis, people do require physical money to settle balances. But Marx says that here money can take peculiar forms of existence, such as credit money or banknotes. So truly, gold is here required as a means of payment only in international settlements, which we will discuss next. In internal circulation, Marx argues that balances could be settled in credit money. So money does not need to be a commodity as a means of payment.
5 minutes,
and finally,
Nicolás.
Okay, thank you. And finally, we get to the last function of money, which is world money. Marx here says that outside of the domestic sphere of circulation, money needs to be the direct social form of abstract labor, which was gold, basically because the symbols are national symbols, so they cannot be used in the world market. So here we have the only function in which unequivocally for Marx, gold has to be physically present, or money must be gold. Having gone through Marx, I think that we can now reevaluate the debate that I presented at the beginning, considering that in his view, the only problem, or to rephrasing it, the only problem at the level of the theory of money is what happens when world money is not gold anymore. And it is no coincidence that these debates really started after the fall of the Bretton Woods systems, when the dollar broke links with gold. So now the first position, which stated that Marx had a commodity theory of money, now can reject the theory because under the grounds that it failed to conceptualize world money. And this has led to two different perspectives, I would say. The first one is to abandon Marxist theory altogether, as done by Aglietta and others coming from the regulation school that started from Marx. And then the other possibility was to start a new approach to money within Marxist framework. So they keep other aspects of Marxist framework, but they just drop the theory of money and try to replace it with a different theory of money. The second position, I think that, I mean, I'm not judging whether they are right or wrong. I'm just saying that I don't think that they reflect Marx's position properly. So I think that it can be discarded in terms of the debate. And the third position now acknowledges that it is true that Marx's formulation has some problems to conceptualize world money today, but they believe that this could be achieved by developing categories present in Marx, such as capital and credit, instead of rejecting the whole theory of money. So going into some more detail, the first position, again, that argued that Marx had a commodity theory of money, and therefore now it's not suitable to explain the current system anymore. Argued that the US dollar broke links with gold and became itself world money. Then that this was done through a process of international competition with other national currencies. And this position has been criticized by the authors of the third position. For example, Lavrinidis argues that the absence of a monetary role for gold is so self-evident that they do not support it with any fact other than empirical observation of the lack of any fixed relationship between gold and the US dollar. Adding up to that, Wick says that this is not a serious argument because there are many aspects that cannot be seen and yet analytically valid, for example, values. And my own take is that this position ends up throwing the baby out with the bathwater, insofar as they are discarding all the elements of Marx's theory of money, even though they themselves acknowledge that otherwise Marx's theory is sound and convincing and internally coherent. So the third position argues that Marx's theory of money is essentially correct, but it acknowledges that the concrete forms of money are having changed, and the post-Bretton Woods system is a new and distinct international financial and monetary system. However, they attempt to develop categories already present in Marx's account in order to account for that, and particularly to explain war money today. So for example, they developed the notion of the dollar as quasi-world money instead of as world money. Within this framework, some authors try to show that gold plays a monetary role today, albeit a different one than before. However, since this approach is developing, I will argue they have differences, particularly in how to conceptualize central banknotes. Some of them argue that central banknotes are symbols of value, so they continue in a way developing the theory of money, while others argue that they are not symbols of value, that they are credit monies. So they try to conceptualize or to fill this theoretical gap at the level of war money with a theory of credit, complementing the theory of money.
Nicolás, if you could please wrap up.
Sure. Yeah, sorry. So just to conclude, I think that in Marx's theory, money must be a commodity, but it appears only ideally, or it can be replaced by symbols in the performance of some functions. On its own, it has problems conceptualizing war money, so it doesn't directly allow to properly account for contemporary forms of money. The question of how to understand them is an open question in Marxist scholarship. However, my own intuition is that this conceptualization could be accomplished by systematically developing the categories already present in Marx's account, such as capital and credit, instead of rejecting them whole. Okay, thank you.
Thank you very much, Nicolás. Okay, so now we have Karen's presentation.
Yeah, I just need to come on here. Start video, yes. Yes, fine. Yeah, I'm on. Do you have my voice?
Yes, yes, we can hear you. If you can share your screen, please.
Yes, I'll share screen now, yes?
Yes.
Okay. Well, my speech is very much aligned with continuing the speech of the previous speaker. It's about the money view and Marx's theory of money and credit. And the background is that Marx's writings on money and capital, credit and banking has been very little discussed by Marxists. Nicolás touched a bit upon it, but this is where I continue, trying to make a link to modern money. Marx's writings do contain the embryo of a so-called money view of the economy, namely that all transactions go through money and that money is chameleonic. Money view is a term coined by Perry Merling. Money view deals with the money system comprising central banks and the private banking system, including shadow banking, government debt, and the consumer's role in the system, looking at it as a flow between a hierarchy of institutions, but not one that is necessarily fluid. Is that in correspondence with Marx? This is analyzed through monetary history of central banks and money markets so as to find out what a modern Marxist monetary theory, a so-called MMMT, would look like. This presentation is much shortened compared with the paper, which is available. First of all, part 5 of Capital Volume 3 discusses the Bank Charter Act of 1844, the monetary crisis of 1847 and 57, very little about 1866, and the underlying causes, and more importantly, it analyzes the monetary system and its workings at that time. Secondly, Walter Bagehot, who published Lombard Street in 1873 and who is said to have formulated the central bank rule, lend freely but at a high rate. Thirdly, Perry Merling, an unorthodox economist with solid roots in the most broadly founded economic literature and history, who combines finance and economics with rare insights and who, like Marx, concentrates on the mechanisms of the system as it has developed. He has written the new Lombard Street with express reference to Bagehot. Fourthly, among Marxists, Rana Vasudevan, who has tried to link Capital Volumes 1 and 3 on money. And I will not talk about Volume 1, which has been discussed a lot by Nicolás. Interest is paid in Capital Volume 3, Part 5. Marx starts with discussing what is interest, what is the interest rate, how come that interest is paid in the capitalist system. We're not talking about the pre-capitalist system, but the capitalist system. Interest is paid on money capital, which is defined as money which is lent out if it is not needed at the moment, and more by professional money lenders, loanable capital. Interest in capitalism is part of profits. Gross profits is equal to interest plus profit of enterprise, or you can say gross profits are shared with money lenders, those sitting on money capital. Loanable capital is a mystified form of capital where it looks as if money begets money. The size of the interest rate cannot be determined theoretically because there's no natural interest rate and there's no inherent value like there is in commodities. But the interest rate is smaller than the rate of profit and larger than zero. We also have cases in history where it has been higher than the rate of profit, but that's a different matter. It's not normal. Therefore, Marx expressly has no theory on the determination of the rate of interest. It is a product of competing demands and supplies of loan capital. The magnitude of the interest rate is not connected with price levels, nor the demands for real capital. This is some of the discussions that going on in the literature today, and Marx is very clear about that. In the capitalist cycle just after a crisis, demand for money capital is low, therefore interest rates are low, but the link is indirect and goes via the money market. Marx detects 3 money circuits. It's not written that clearly, but you can read it out of him. And they all converge on the same point, namely the banks. The revenue circuit is the ordinary transactions where money circulates, income and spending by households and businesses on a daily basis. Money as means of circulation, you could say, to link back to Volume 1. The credit circuit, monetary credit originally developed around trade, not least bills of exchange. The capital circuit, loanable funds lent out on security to fund typically businesses, the money capital. The tendency is for those circuits to become interwoven. That has been the historical tendency. Deposits and reserves. Bank deposits have, according to Marx, a double existence. First is actual money, and then as a claim to money. Deposited money does not sit on the accounts, but enters the bank's balances as assets on the basis of which loans can be made or securities bought, i.e. there's a transformation on the asset side, which will lead to more deposits, more liabilities. But as the deposited money may be withdrawn, a shortage of liquidity can result. This is what Marx says. Deposits are never more than credits with a banker. Insofar as they are used in clearinghouse transactions, they function as capital for the bankers after these latter have lent them out. The bankers pay one another reciprocal drafts on these non-existing deposits by balancing these credits against each other. It's not that simple, as you can see, but on a short formula among banks, claims very often cancel, so when a settlement mechanism is set up, liquidity can be spared. In the mid-19th century, what was the system? Money and credit, in fact, were becoming substitute. In the UK, the country banks issued notes to discount bills of exchange, so commercial credit increased at the same time that monetary credit did. The counters with surplus lent to those with deficits through drafts. Ultimately, Bank of England notes came into play. The next step was that bills were used along with paper notes as a means to make payments, depending on their quality and acceptability. So bill brokers, the shadow bankers at the time, could sell bills without discounting them. The question was just of the haircut that they had to take when they sold prematurely, and the other way they would take haircuts of other people. Credit became intermittently money as a means of payment. Before crisis, there was hectic activity and the security of bills fell. Therefore, all of a sudden, real central bank cash was needed. Sorry, I have to go back. How do I get back here? I have a problem. Just a second. Sorry about that. Here we are. Well, I was going to the Bank Charter Act, and what can I do?
Has your computer froze, Karen?
Yeah, what should I do?
At this point, can I suggest, can you present without the slides and make a general
No,
overview?
I would like to stop share. I can go out of. You hear me now?
Okay,
Can you hear me now?
Yes, we can hear you.
Then I can share screen now.
Can you try again?
Yeah. Share. Yes, here we are. The Bank Charter Act of the Bank Charter Act of 1844. Do you have it?
Yes, we can see it. If you can do presentation view.
Yeah.
So we can have the full screen.
Where do I get the presentation view?
So if you go down below, just close to the 65% zoom, there is a button just next to it where you click presentation view.
I can't get in. I can't get into Zoom. That's the problem.
F5.
Pardon?
If you press the button F5 on
F5.
the laptop, yeah, should do it.
F5. No, I don't have it. What do I do? You share. I'm trying to share here. You see it? No. What do I do?
Karen, can I suggest, can
Yeah.
you unshare your screen and you go through your slides and just talk and without sharing your screens? Maybe your computer would respond.
How about my leaving it? Anyway, well, yeah, I can go through them now, but this is, anyway, I was going to the Bank Charter Act, and I would need to show that because it's very important. I'm sharing now. Sharing, you see it?
Yeah, we can see the slide. No, we cannot
You
see
the
it
slide
anymore.
now? Okay, fine.
No, you unshared it.
Pardon?
You unshared, you have to share again.
Yeah. And you have it? You have it?
Yes, we can see it now.
Okay, thank you. So that's the important thing. Well, this is the Bank Charter Act. I'm so sorry about that. Bank of England got separated into the issue department and banking department. So the issue department issued notes, and on the basis of government debt, other securities, and gold and silver coin and bullion. The banking department, on the other hand, had proprietors' capital, public deposits and bills, and notes from the issues department as assets, whereas they were liabilities before. At Bank of England, the issue department could only issue notes corresponding to gold and silver coins and bullion plus securities to the tune of 40 million pounds in fiduciary issue. The notes of the banking department and in circulation could not exceed these reserves. Notes were liabilities in the issue department, but assets in banking department, but they were not at the same magnitude though. But it's interesting that the same phenomenon is on each side of the balance sheet. In crisis, when BOE notes was demanded, there were not sufficient notes. 3 times the act was suspended to exceed the limit, so as it was able to succeed the note limit, but only once were more notes actually issued. As gold holdings only occasionally exceeded 16-17 million pounds, compared to bills in circulation in the UK of 300 million, the money base was small, yet the system was centralized in the Bank of England. Problems arose particularly when the UK lost gold due to crisis or external deficit, and Bank of England had to destroy notes. In later years, Bank of England wanted the free reserve, i.e. to have more gold than it issued notes for, so as to be able to act in crisis. In the bank crisis in 1890, it borrowed gold from Bank of France and Russia so as to be able to issue notes, so suspension of the act could be avoided. The bank came to manage the money market and help it in crisis. To regulate the exchanges, it used bank rate, increasing it when in need of inflow, thereby rescuing the gold reserve. An increase in banking department securities allowed it to take more deposits, but not to issue notes. Its discounts were particularly those for foreign trade. According to Marx, the unbacked notes of fiduciary money were tokens of value. Problems. Banking department had no recourse to issues department. The banking department balance was larger than the issues department because it could take deposit and have securities and discounts on each side of the balance sheet. But securities could not be converted to notes, and so were not money. This was the important point. In crisis, according to Batchett, the Bank of England should continue to discount and lend to keep the all-important bill market afloat. Purchasing securities in open market operations would not help because it was the bill market, the trade market that was in problem. A modern central bank is based on making securities liquid and also on transiting from trade bills to government securities as a basis for the money flow. Lender of last resort lent freely but at high rate. 3 suspensions, but when no issue was loosened, the run on money ceased. So that was a very fortunate thing. It was really hysterical panic that was created, but not really a need for this act, this note, the government note. The term lender of last resort was coined after the 1866 crisis attributed to Batchett, but he did not say but at a high rate as is said today. Raising bank rate to protect gold reserves was detrimental to the domestic credit market, especially in crisis. Later, central banks have tended to lower rates in financial crisis and used higher rates as a macroeconomic tools, such as they did in the Volcker crisis. The Fed was established in 1913 after the system of national banks collapsed. And
5 minutes, Karen.
Yes, it was less restricted than Bank of England on note issue, but was still bound by gold. 40% of money issued in gold should cover 35% of deposits. And there was and on the other hand, commercial bills could cover 60%. Money could be created based on government securities and the open market. But the primary market and commercial collateral could also be used for money issue. The US was less dependent on commercial credit than the UK, and therefore the Federal Reserve banks increasingly dealt in treasury bills and capital market papers. The interest rate got to play another role than for the Bank of England. Friedman and Schwartz, they criticized that deposit notes were not really, that are substitutes were not really, substitutes with respect to reserve requirements. There were the 12 Federal Reserve banks, in a way, played the same role as the banking department. They could deal in open market operations and were more free than the Fed sent at central level. But the important thing was that the Fed came to be a dealer in treasury bills and regulated the market. And the money view, here we are, is an analysis of the economy's money flows, which are not just a neutral vehicle for real flows. Money has 4 prices: the interest rate, the exchange rate, the price level, and par, the relationship between different monetary instruments in the same market. These flows are to a large extent based on credit in support of the supply chain. Merling sees a hierarchy of banks, payments institutions, where claims on the top level can be used at lower levels means of payment. Deposits at one level of reserves at another level, culminating at the central bank, where banks' reserve holdings and central bank deposits, ambiguity in the reserve term, as the central banks also have reserves themselves. First of all, Merling is known for his claim that central banks have become dealers of last resort, and because of that role they play on the money market. Central banks are hybrid institutions between the treasury, government, and banks. The world's central banks have an informal hierarchy with the Fed at the top and 5 other major central banks making up the big 6, which are large powers of autonomy. Below that, there are 2 other tiers. And I'm showing that central bank money is based on assets of all sorts. They have become interchangeable in such a way that they are as good as money if they are sitting on the central bank's walls. So they're not restricted like the Bank of England was. They can issue the notes they want to. And they also very much based on treasury bills, which is what has then led to the theory of modern monetary theory, which I will come to at the end. But before that, I'd like to talk about the Eurodollar market and Bretton Woods, and that links up with the previous presentation. The Bretton Woods Agreement defined fixed currencies and a dollar-based gold exchange system, but there were capital restrictions after the war. The Eurodollar market was the response to that. Banks in London could hold dollar deposits as intermediate long-term lending, in fact, investments into Europe, while keeping the dollar side in the books of London banks, mostly branches of US banks. And they had correspondents in New York, but the money was offshore. It was neither part of US nor UK money supply. And when the gold exchange system broke down in 1971, it was thought that it was through this market. But giving up the gold convertibility was not so much the issue as the breakdown of fixed exchange rates. Floating rates were a new challenge, but also fueled new and old markets, such as those in forward exchange, etc. Through it all, the dollar remained king, and the Eurodollar market eventually became the center of dollar payments and funding in dollars. The euro.
Karen, you only have a few seconds, if you could please conclude.
And the euro was then set up, coming up with the problem that the governments would have to be bailed out. And that was not really thought about before, but in the euro, it was thought about, and it was not allowed that government should be bailed out. This was what was necessary in the financial crisis, in the aftermath of the financial crisis, and the euro got around that in various ways. And this is the questions then have become for many people that maybe governments can just fund themselves at will. There will be no restrictions. One of those is the modern monetary theory, which proposes that government can just swap assets with central banks and then use that money as it wants to. But The question then is whether that will not have detrimental impacts on the money markets. And here is my last slide. Central bank reserves today are insignificant compared with the assets that are in principle as good as money, or that is a question. Can central banks, if we have even more money flow, become illiquid? And Merlin says that the Fed is taking the risks out of the market for banks, but whether central banks themselves incur risk by trying to direct and shape the market is a question. By liquidity provision, it eliminates solvency questions. Well, not quite. We saw that Lehman Brothers did fall. EU bailing out banks and countries was done with funds raised in the market with government guarantees. If government guarantees have to be activated, can governments then just do another asset swap? Quantitative, then the question that asked at the last point here is whether the budget formula today could be that governments can borrow freely but at low rates, and is it sustainable? I also would like to say that I have in my paper something about the value of money, where I do go back to the question of gold, and in line with what the previous speaker said, I think there is a role for gold, not in the system as such, but as measure of value and as measure of the value of money itself. Because without that, then we do not have a measure of commodities values. So I will agree with that, but I think that in order to detect what is actually going on, it is a complicated, one has to engage in a complicated thinking process. So I will end with that, and thank you for your attention. And I'm very sorry about the break in the middle, because that was quite disturbing. Thank you.
Thank you, Karen. That's okay. Thank you very much. Yes, thank you. So now we have our third speaker, Juan Santarcángelo.
You have to give me.
Let me request.
Okay. Great. Thank you. Thank you, Danielle. Well, I would like to start by thanking all the organizers of this beautiful event, all the people working here, Ingrid, Danielle, Eurodollar, John, and all the people who is present. The aim of my paper is to account for the role played by Marxian theories regarding economic development. And I do this starting from the origin of the discipline, its heyday in the early 70s, and its practically abandonment thereafter. My goal in a certain way is to rescue the most important Marxian contributions to economic development. I'm going to start briefly with a little of history. Economic development as a main topic of economics started as a discipline after the end of the Second World War. It went hand in hand with the creation of several institutions, the ILO, the ECLAC, the World Bank, the IMF, among others, which were mainly designed to help developing countries to improve its living standard and also to promote the virtues of capitalism, and also to discourage the third world countries of the temptation to align to the Soviet Union. During the post-war period until the beginning of the 70s, which is commonly known as the golden age of capitalism, most countries were able to achieve high economic growth rates together with substantial improvements in labor and income distribution and most of the social indicators. But then economic development went from being understood as a mere synonym of economic growth to include several dimensions. At the beginning of the 50s, economic development was equal to economic growth exclusively. And at the beginning of the 70s, the term had more layers inside of it. It includes the generation of employment, the transformation of the productive structure, the increase in the use of technology, and even income distribution. improvements. Between this period, between the 50s and the 70s, there were basically two main groups of theories. The first one was a bunch of theories that explain development looking specifically at each country. They include the theories of Rostow, which understood development as a linear process given by the progressive succession of stages. Then also include the works of Ragnar Nursky, the balanced growth theory, or the unbalanced growth theory of Albert Hirschman, or the big push theory of Paul Rosethen-Rodin. According to all the theory, what they have in common is that there is no big conflict of interest among countries, and all the world, in a sense, could be fully developed if they do the right things. The second group of theories is the Marxian group and the leftist group, who point out that the root of underdevelopment was essentially linked to the functioning of the capitalist system. Among these theories, we can have imperialism, monopoly capital developed by Baran and Zwissi, and dependency theory. I'm gonna revise very quickly the main ideas of this theory, and then I'm gonna come back. But first, before doing that, I'm gonna start reviewing what Marx did on the subject of economic development. Marx, as many of you were aware, did not specifically study the process of economic development as such, and even the term was never used by him. Therefore, what Marxists usually do is to look for the contributions to economic development in his extensive work. Marx's theory of development or progress bore similarities to that of the linear stages model. For instance, in the introduction of the first volume of Capital, he stated, "The country that is more developed industrially only shows to the less developed the image of its own future." Capitalism, in this respect, was regarded as just one stage in a transition. The beginning for Marx was pre-capitalist societies, which Marx differentiated between Asiatic, ancient, or feudal. And all of them would be replaced by capitalism, which in turn would be overthrown and socialist form of organization and production would prevail. For Marx, development was a process of capital accumulation occurring unevenly in terms of class. The owning class become richer, and space, because some countries become richer than others. With this background, the first economic theory developed after Marx, which had a significant influence in the third world countries, was imperialism, which was a term coined by a journalist named Hobson in 1902. Imperialism signified on the whole the aggressive expansion of Europe into Africa and Asia, the division of the world by the great powers, and the rise of inter-imperialist rivalries. The classical theories of imperialism were formulated at the beginning of the 20th century, subsequently by Hilferding first, highlighting the finance capital, then Luxemburg, then Bukharin, and finally Lenin. And I'm not able to enter into detail of each of them here, but I'm gonna just present a few things on Lenin and Luxemburg ideas. For Lenin, imperialism was an integral part of late capitalism and not a mere policy. And while he saw it leading inevitably to global conflict, he conceived capitalism as developing the forces of production everywhere. Rosa Luxemburg, on the other hand, while more explicitly concerned with the social impact of capitalism, saw imperialism as part of the great drive to expansion, which was at the heart of the capitalist system. The second Marxian theory came from the work of Paul Baran in 1957, and with Paul Baran and Paul Zwissi in 1966 with the publication of Monopoly Capitally after Baran was passed away. This theory builds on Marx's argument that the scale and capital intensity of production and the centralization of ownership increase as capitalism develops. This process leads to a growing monopolization of capital, so that at the same point in the late 19th century, monopoly supersedes competition and ushers a new stage of capitalism. Monopoly capitalist authors think that Marx's capital was what they call the competitive capitalism. And during the 20th century, capitalism transformed into a monopoly capital. Finally, the last group of theories that I'm gonna review in the paper is the dependency theory, which arose mainly as a reaction and criticism of Latin American structuralism created by Helveg and Raúl Prebisch in 1949-1950, at the beginning of the Helveg. Dependency theory occurred at the beginning of the 60s, and the key argument was that underdevelopment was a consequence of the operation of the capitalist system. According to this approach, the theory of economic development and underdevelopment are not two situations in a successive stage of continuous process, but they are linked. Underdevelopment, in this sense, is a structural situation caused by an unjust and unequal world economic organization. Under Gunther Frank, a famous dependency theory, termed this the development of the underdevelopment. So at the beginning of the 70s, many of these discussions were present. They were mainly dominated by Marxian and leftist tradition. But what happened was that different processes were start to implode. At the beginning of the 70s, the stagflation occurred, which derived in a strong debate between neoclassical economics and Keynesian economics. It gave through to the dominance and the rise of neoliberalism, and also on the transformation in the role of the state. This was very important and happened all around the world, was also accompanied by strong political changes. For instance, Reagan achieved power in the US in 1981, Margaret Thatcher in England in 1979. In many of the developing countries and third world countries, there were a succession of different military coups. Chile in 1973, Argentina in 1976. And all these transformations generate an abandonment, not only of Marxian ideas, but also of progressive ones. By this transformation, most of the approaches based on center periphery or imperialism were replaced by what we now know as globalization. We are very used to the term globalization, and the problem is that in globalization, it seems that there are no different hierarchies and positions of countries within capitalism. Those are eliminated. When we talk about imperialism, one country was the imperial country and the rest were no. And when you have center-periphery relationships, some countries are the center and some countries are the periphery. So as a result of all this process, most third world countries have worsened their quality of life. The discussion has lost a lot of power, and especially a lot of power of transformation. So I believe that there's time, this is time for economic development to recover Marxist tradition and many of the its useful insights. I can point out several contributions to end up my presentation. First, I think we need to remember that the capitalist system generates powerful order patterns that transcend historical and regional particularities. This means that the system has internal forces that gives you certain regular patterns. And in order to design alternative strategies of development or define priorities or pursue certain objectives, this is very important to have in mind. A second element that almost has disappeared from economic development discussions is the role of profits. The profit motive for Marxian economics is the dominant factor in the regulation of investment, growth, employment, business cycle, inflation, and many other things. And today is not clearly present in many development discussions. They are in a way hide below some other discussions. When we discuss about the development of some country, we present it in a way that we are concerned of how much growth the country will have, and not about how much income distribution will be transformed for the lower classes. A third element that also needs to be reincorporated is the study of a more complex and realist notion of competition. Shaikh, which was my advisor when I was doing my PhD at the New School, called this real competition. I think that we need to recover the real competition into the analysis. We need to go beyond the dominant analysis and give the competition its central place that it has. Fourth, we also need to recover the central idea that development and development are inseparably linked, and they are two sides of the same process. For me, it is clear, as for many Marxists, that the world has hierarchies, histories, and not all the countries have the same possibilities to achieve economic development. And finally, we also need to transform the way we think about development. In the early 70s, income distribution was the central variable of dispute between capital and labor. But today, 50 years later, in a way, the axis of development focus more on growth and employment, assuming that eventually a virtuous dynamic will drain and lead to a distributional improvement. I think that this issue is one of the most important victories of neoliberalism, the way it transformed the way we think in economics and particularly in economic development. It's a way to hide all the real role that income distribution and profits has in economics. I think it's time for Marxian economics to recover its role in the economic development literature. Thank you.
Thank you, Juan. That was great timing, 5 minutes before. Excellent. Thank you very much. I will bring all the speakers back. So Nicolás and Karen, if I could ask you to come back. Okay, so I wonder if there are any questions from the audience at this point to the three speakers. We did receive a few questions through the Facebook page as well. Oh, we have a question here. So I'll gather a few questions. We can do it in rounds, if that's okay with you. I'll gather a few questions and send them to you. So I'll start with the first one that we just received from Leandro Bona. This is for Juan. So he says, what's your opinion about recent debates on imperialism, such as the ones between David Harvey and Prabhat Patnaik, who is going to present his view during this conference in a few days, so hopefully. So Juan, I'll give you this question. I'll also give two other questions to Nicolás and Karen, then I'll ask you to, because then you have a few minutes to think about the answer as well. So Nicolás, we had one question from Facebook, which is about how Marxian theory of money can accommodate current trends such as digital currency. So this one's for you. And for Karen, we had a question about how relevant is the role of lender of last resort during the COVID crisis? Okay. So Juan, can I ask you to speak first, and then I'll give the floor to the others?
Okay. Well, I don't know what Leandro, okay, yeah. I don't know what Leandro means by the debates on, the recent debates on imperialism, but I think that they are very interesting debates between Harvey and Patnaik. I think that one of the key issues that I was pointing out is that imperialism is in a way abandoned from the economic development literature, and I think that it has to be restored and recovered. I believe that it's very crucial to understand how the world is gonna evolve, and if the US and China discussion and imperial rivalries will end up in the present. I think it's an open dispute. It is, for me, it is no clear which imperial power is going to prevail. But I think it's very important to recover the idea of imperial discussion and to think all the reach that the imperial force has in many of the countries. So I'm very eager to listen what Patnaik has to say in the central session.
Okay, thank you. Nicolás, can I ask you to answer the question, and then I'll gather another round of questions. I'll give this to you first, and then I'll go to Karen's question, and then we go again.
Okay. So on the digital currencies question, there have been recent contributions trying to discuss that from a Marxist point of view. I'm not super familiar with the topic, but my own position is that if it remains true that that money must be a commodity, then digital currencies cannot replace money, but they can just be ulterior forms of banknotes. For example, they can replace banknotes as a new form of what I would say credit money, but they cannot substitute money in the ontological sense of the word and in the structure of the role of money in capitalism.
Thank you. Karen?
Well, in a way, there was a little, in the COVID crisis, there was a short crisis when supply chains broke down and the money had to be blocked a little bit, so interest rates were rising in the market, and then the Federal Reserve and the other major banks intervened and flushed the market once more with liquidity. But that was just a short while, then it stabilized. So I would say that the lender of last resort was only intermittently used here. But what is going on now is that some economists or progressives want the central bank to have a much more expansive role and go out and be lender and furnishing, intermediating development, growth in the economy. So that's a much more aggressive role than the passive role of being lender of last resort when everything else breaks down. And I would like to say to, maybe if I may comment on the other question of Bitcoins, that the Bitcoin is a way of trying to escape the central banks, as far as I can see. So it's a market-based instrument to get around that and get around maybe also official channels. But so far, the central banks are not willing to give up their power. So I do not believe that it is money at this point in time, or ultimate money. So that was my answer. Thanks.
Thank you very much. We do have a few more questions here. So there are two questions directly to Nicolás. So Nicolás, I'll pass them to you, and then I'll go to answer a few round of to ask another round of questions. So we have two questions here for Nicolás. So first, can you tell us how pre-capitalist money formed or functioned? What was the relationship between, for instance, the antique or the feudal economy and money? So this is the first one. And then the second one to Nicolás, if you can expand on how Marx's categories of capital and credit might be used to update a Marxian conception of money.
So yeah, on the first question, on the pre-capitalist money, what I would say is that money had a role in the margins of the system, mostly related to international exchange. That's how money actually started to be used historically. These were societies that were self-contained in a way, and they were planned. So there was not the need for this indirect mechanism to assign social work, because everyone knew what had to produce and how much it had to produce of that, and how much it will get from his or her production. So there was a direct allocation of social work. So the mediation of money was not needed. Money only started to be used in international exchange when these societies began to have a surplus that they could exchange, and they also began to have interests in acquiring the goods produced by other societies. The second question, how the categories of capital and credit might be used to update a Marxian conception of money. I think that in line with Karen's presentation, Marx in volume 1 discusses money, but then in volume 3 he discusses credit. And credit and money are two different things. Credit is a promise to pay money. So in order to have a concept of credit, you need to have a prior idea of money. And credit starts privately as commercial credit, and then it begins and it becomes then bank credit, and finally central bank credit. So what I would say is that, or what I'm thinking right now, I might change my mind later, is that central bank notes are a form of credit money that it is at the top of the credit hierarchy, but it is not money. So the credit monies have a hierarchical structure with private promises at the bottom and central bank money at the top. So it's not the same if I gave you a promise that I will pay you some amount in the future than if the central bank gives you the same promise. And in the middle, there is a commercial bank whose promise is worth more than my own, but less than the promise of the central bank. So in this way, I think that you can start from money, but then develop the theory of credit until you can fill the whole circle and provide an understanding of both money and credit together. And by the way, this is not a problem that is only for Marxist theory. The relationship between money and credit is very blurry, and it's also present in Keynesian economics and in chartalist theory of money, and even in neoclassical economics, although in a very confused and mixed way, because they don't recognize that they are discussing in these terms. And then there is one question: would it not be simpler to just acknowledge that Marx was discussing the financial system as it existed in the 19th century? Maybe that question is more for Karen than for me. What I would say is that it will be simpler, but it will be wrong. If what you're trying to do is to explain the system, you gotta go deep and discuss and take the question seriously and go in depth. For example, what many Marxists have done is exactly that. They are saying, okay, then Marxist theory of money is not useful anymore. But I think that what they get lost in a way because they do not get an answer that is more powerful than the one that Marx already gave. And of course, the system is different. So you gotta, at the same time, be able to develop Marx's ideas in order to account for the reality as it is today. But that doesn't mean that all that he said is now worthless. Thank you.
Thank you, Nicolás. Can I pass this question to Karen as well? I was gonna direct the question to you both. Karen, what are your views about Robin's comment?
Yes.
So
yeah. Okay, thank you. I would say that there's this question about central bank money and credit money in ordinary banks, where the ordinary banks want to get rid of cash, so to speak. Cash, of course, also being central bank interest. And in that way, they have too little cash. And whenever we see a financial crisis, it always erupts in that phenomenon that ordinary banks are cash short. And therefore, they have to go to the central bank to get real cash, which is from the central bank. And which are scripts and not notes nowadays, but that's where they address themselves. So whereas banks can act as if what they produce is money, if it is accepted, then it is not always accepted, and that's when the central bank comes in. So far in crisis, we have not seen a run on gold ever since the 1860s. But today on the other hand, we have we did see something in the Bretton Woods days when countries wanted gold from the US, by the way. So that time did play a role. But the whole thing about central bank money is that it is central. In the UK in the 19th century, banks wanted notes. They didn't want gold. It was only in external exchanges that they wanted gold, which confirms what Nicolás is saying. It's just that now, what do banks, international exchange, need now is dollars. So the dollar is king and is the one that is, and the US Fed is organizing a lot of swap lines, a lot of credit lines with central banks, whose countries have come into trouble because every country needs dollars in order to get on with it. Incidentally, I would like to tell you something. The two other speakers are both from Argentina, but it's very important, I would say, for imperialist theorists to follow the money too. And one of the first crises, which was international in order, financial crisis, was with Argentina, namely in 1890. And what was the result of that crisis? It was that in order to bail out Argentina, this was a complicated process, bonds were issued in the London market, and for that they actually demanded Argentine assets. So that was a way of getting Argentine assets. That has happened ever since then. Then also in modern times, when we have seen the recent crisis. So, but that was the first time that I'm aware of that this type of thing happened. So I think it's very important for imperialist theorists to also follow the money. That's my point.
Thank you, Karen. Okay, we have a question now for Juan from Michael Roberts. So Juan, you said that the profit is the driver of capitalist accumulation, but it has been neglected in modern analysis, even Marxist ones. Why is that? And what has been lost by ignoring profits?
Michael, thank you very much for your question. Of course, not all it has not been neglected by all Marxists. Your analysis, Shaikh's analysis, Mosley analysis, for instance, Saad, Philo, and many others inside the Marxist tradition, they realize the real role of profits. My point was that it was neglected in the economic literature, maybe mostly outside the Marxian tradition, not in Marxian analysis. And why is that? I think that that's because of the whole transformation that the world has suffered in the from the 70s until the present day, when we the labor class and the labor movement, we lost. We are losing a lot with neoliberalism, I think, and that's why. And what has been lost by ignoring profits, I think that what happened is that most of the things have been transforming the way we think about it. I'm going to put an example. For instance, Argentina in the middle of the 70s was the most industrialized country of Latin America and has the most important working class, the most significant and combative working class. And the demands of the working class at the middle of the 70s, before the military coup, was 50-50, were to get 50% of the income share. And we got the military coup in 1976 until 1983. And when we recovered democracy, our demands of the labor movement was to recover the people who were disappeared. And we never again discuss the income distribution as a labor movement, never again, and not the 50-50, not even the 40. So I think that that's why. And for instance, when we thought, when I was doing my dissertation was trying to relate the relationship between growth, employment, and income distribution, and challenging the idea that was prevailing in Latin America and Argentina, that we need to growth, but not only to growth, but also to generate employment, because in that way we can improve the standard conditions and the income distribution eventually. And in my dissertation, I proved that that was not the case, that if you don't change drastically the structure of your economy, and you don't get a strong labor force able to challenge and dispute and win more shares of income distribution, you are not going to be able to change it. So that's why I think.
Thank you, Juan. We have 5 minutes left, so we have, I'll just pick up one more last question. And this one relates to all three presentations, I would say, which is not as specific to anyone. So I'm just going to ask for each speaker to make a brief comment. Is it possible to relate the Marxian view of money, imperialism, the systematic decline of the role of the state, and the increasing penetration of finance in daily lives? So I wonder if you have any thoughts on that.
Yeah.
We hear you now.
Yeah. Well, that's a big debate. I mean, what we have seen in recent times is that central banks have become more and more powerful. At least markets depend on them more and more. So, but is that because the central banks are subservient to the private market, or is it because they're dominating it? And that is the main question that I'm not able here to answer right away. But I do believe, as the question sort of implies, that in fact central banks are subservient to the private market. They are sort of, when you look at interest rate setting, it's said that they do set interest rates, but you can see that they are more responding to what is happening, what they have been forced to do anyway, and they are not really directing the markets. They have been doing that in past history, for example, in the Volcker shock in 1979, but at this time, nobody wants negative interest rates, but we have negative interest rates in major economies, and that's something that has been opposed by this hyper liquidity, in my view, and therefore I do think that the regulation or the dealer function of the central banks with the money markets is to really feed the money markets so that they can prosper, and thereby also making the rest of us, so to speak, suffer. So it's a very, very difficult question to answer, but I tend to go in that direction, but I do not have the final arguments yet.
Thank you. Any comments, Nicolás, Juan?
Just a quick comment. It is clear that since the 70s, we're living in a new world, in a way, in a new phase of capitalism, which you can call neoliberalism, globalization, financialization, or however it suits you. But it is clear that finance plays a key role, and there are forms of finance that that could be considered as a new form of imperialism, or as additional forms of imperialism that that work to subjugate underdeveloped countries in general. So there are many authors working on this idea of subordinate financialization, which I think is very fruitful. And within that, you need to consider the role of short-term capital flows, the role of external indebtedness, which has become a key tool of not only economic but also political domination, and other mechanisms. So yeah, definitely. And I think this is there is a huge body of scholarship now working on that, and it's a very interesting field of research.
I would like to add a comment too regarding that question, if it's possible to relate Marxian view of money, imperialism, the decline of the state and the growth of finance. And I do believe that it's possible. And I think that in the last years, couple of years, we have some very important contributions that I would like to mention. First is Anwar Shaikh book, Capitalism. It has all of those things together, and also with a more presence of money, of the discussions regarding money and Marx and all related issues. You can get Fred Mosley book, Money and Totality, which is an excellent book to read, and who has many of these issues combined in an actual and Marxist way.
Thank you very much. So we're coming to an end of the session, so I'd like to thank the three speakers for the great presentations, the great discussion. I'd also like to thank the attendees for staying to the end. So we now have a break of half an hour, and starting in 30 minutes, we have a session on teaching heterodox economics. So if you'd like to attend that, you just go on our website and you can register, and you're gonna get the Zoom link to join, okay? So thank you very much, everybody, and see you soon. Take care.
See you soon.
Bye-bye.
Bye-bye.